Good afternoon, or good morning, or good evening, depending on where you're joining us today. Today, we're welcoming you from Oxford, from Said's Business School, to join us for why bank governance matters more than ever. Please take your time joining the chat. We would love for you to start introducing yourself in the chat function. My name is Sarah Barrow. I'm one of the senior program consultants here at Said Business School for Oxford Executive Education. I oversee the finance portfolio and the bank governance program. Today, we're going to be running a 1-hour webinar starting now, and we'll have a brief introduction, 45-minute discussion. We'll then welcome any questions, and then we will share more with you how you may wish to join the Future Bank Governance Program starting this summer. So that's housekeeping. We would love to see more of you introducing yourselves, saying where you're from, what your interest in bank governance is, and any involvement you may have had with the business school to date. Today, you'll be talking with Amir Amel-Zadeh and Kern Alexander, the co-directors of the Bank Governance Program that's been running here at Said Business School for 6 years. This summer will be the 7th iteration. I'd like to take the time now to allow them to welcome you to our webinar. Thank you. Over to you.
Thank you, Sarah. Welcome, everybody. Good to see people joining. I can see more participants are joining. So welcome from wherever you are. As Sarah said, just introduce yourselves in the chat, and please also use the Q&A function to ask any questions as we go along. So we want this webinar to be interactive as possible. My name is Amir, as Sarah mentioned, and together with Kern, we are the program directors of the Bank Governance Program. I'm also associate professor at Said Business School. Kern is professor in Zurich, and he can maybe introduce himself in a moment as well. And we are very happy to have you on this call. There's lots going on in the world at the moment, and lots that essentially bank boards and banks in general need to think about when they think about risks, changing geopolitical landscapes, and how essentially the way of working is changing also with technology shifts. So there's plenty to discuss, plenty to talk about, and we will try to essentially engage with you in a discussion, and are very keen to hear your questions so that we can actually discuss a little bit more interactively. I think that's much nicer. Sarah will talk a little bit more about the program, Bank Governance Program, later on as well. And we hope that you're interested in it, and we hope to see you on that program later in the year. Great. Kern, why don't you introduce yourself just briefly?
Well, thank you, Amir, and thanks also to our great administrative team at the Said Business School for putting on today's webinar. It's a pleasure for me to be on as well to speak with you today about the Bank Governance Program, and also some of the big pressing challenges that bank management and bank boards are facing internationally today, given the fact that we've got unprecedented geopolitical risk and uncertainty in the world. And so what we will try to do today is to discuss some of the main challenges and some of the issues that relate for banks in an ever-changing financial market, where we have this sort of you might say non-economic risk has become all pervasive and threatening and posing challenges for bank governance.
Thank you, Karen. And we can dive right into it. As Karen mentioned, I think if you think about kind of what governance means for banks nowadays, in today's world, I think you can clearly see that it's not only about economic or financial risks, and bank boards need to think a lot more outside kind of their comfort zone. And in particular, I think there's like 3 main themes, or 3 main trends that you want that are important. So one was the fragmentation in the global order, and with that comes essentially geopolitical risk, as we've seen with conflicts, obviously in Ukraine, but now also in the Middle East, how quickly that environment can change. And we want to think a little bit more about what that means for banks. There's digital transformation, AI is a big theme, cybersecurity, and of course, digitization of money, and particularly for the financial sector of interest, stable coins and how banks are getting involved in that system. And of course, then what is a traditional theme for banks, I think, is still conduct and accountability, but that has essentially become a little more to the fore in recent years with some, let's say, cultural problems at certain banks, some conduct issues on the highest level of the board of some of the banks. And I think we can talk about that as well. But why don't we start with geopolitical risk and kind of how we should think about it. And Kern, I know you have done quite some research on that and have written actually a couple of articles also how central banks and regulators think about these issues. So how should bank boards think about geopolitical risk? What's the transmission mechanism? Why is it important for banks in the first place?
Well, right now, as most of us who follow the global economic developments know, stock markets are at an all-time high. Financial markets, asset prices are rising in different sectors. And although there's some turbulence, financial markets seem to be somewhat resilient. And one of the reasons why they're resilient is because the banks and other financial institutions in these markets had stricter regulation to comply with after the global financial crisis of 2008. Higher capital requirements, stricter liquidity requirements, stricter standards and guidance for bank governance and bank management. And so that's produced benefits, economic benefits. So when the COVID crisis hit in 2020, and now we have these political uncertainty and tensions in the world, the financial sector has been rather resilient in dealing with these risks and uncertainties. However, that's not enough because in the future, what many commentators and economic policymakers at the IMF and the Bank for International Settlements have said, because there is high levels of debt and high levels of leverage and a type of asset bubble in the financial markets, it only takes one sudden unexpected event to cause a reversal in the markets and to cause a sell-off, so to speak, or to cause a sudden shock that might create a lot of volatility in the markets. And that's why bank boards need to be prepared for this. They need to be thinking about how to manage the impact of these potential shocks. And so I would suggest kind of at the outset, we have a lot of time to discuss today what they might do, but I think very generally that might involve bank boards requesting enhanced improved data on their risk exposures, especially their operational risk exposures. Operational risk, is the area that deals with kind of financial crime, operational breakdown, and even kind of external political, social impacts that affect and can hurt the operation of the bank. Another area where bank boards ought to be looking at closely is cross-border coordination with management. If they're in a bank group operating across borders, they need to coordinate with their subsidiaries and their other units operating in other jurisdictions to be aware about what regulatory expectations are in the various countries where they are operating. And then finally, I think that another key focus for bank boards ought to be the adoption of stress tests for geopolitical scenarios. Right now, if we look at the stress testing models on the Bank of England website or the European Central Bank, we'll see that stress tests are looking more at sort of economic risk, traditional banking crisis or kind of shadow banking market failures. How would the bank be affected? But now I think there's a time to have these stress tests need to be adjusted to incorporate geopolitical scenarios. So those are things that, and amongst other things that we can talk about today.
Thank you, Kern. And we can pick up on some of those. In particular, you mentioned resilience. That banks have so far been resilient, given essentially the kind of regulatory response after the financial crisis, the higher capital buffers, and somewhat benign kind of economic environment. And now as we see this geopolitical risk coming to the fore, I guess there's various mechanisms how this actually translates into risk. From my perspective, if I think about it from an accounting perspective, there's a market channel, right? So there's obviously volatility in commodity markets, as we've seen with oil prices and FX rates pretty volatile around this time. And that obviously begs the question how hedged essentially financial institutions are in some of these areas. There are balance sheet impacts in affected jurisdictions, right? If you think about collateral values around say real estate, maybe in the UAE. And of course, there's the regulatory channel where maybe there's sanctions, asset freezes, or other essentially imposed kind of risks imposed by sovereigns. But you mentioned kind of the operational channel. So in how far, so what is the regulatory expectation? So what do regulators actually want banks to do in managing geopolitical risk?
Well, geopolitical risk falls into the category of operational risk, and under the Basel framework, there are capital requirements. There's a framework in which to assess, based on the bank's revenue and earnings, what is the expected impact of operational failures and under the Basel framework, the bank capital requirements with respect to operational risk can be adjusted if the bank shows enhanced operational risk management systems, then they can get a break on capital. And that's part of the supervisory dialogue that banks should be having with the bank regulator, is what type of operational risk systems they should have in place that deal not just with the internal operational risk, the internal failings that might be IT or might be employee related, but we're talking about external risk that can affect the bank outside of its institutional framework. And that's really the risk that I think have become so prominent in the last year or so with respect to armed conflict, cyber attacks, sanctions, supply chain disruptions. These are all examples of kind of external, or you might say exogenous risk factors that are of a geopolitical, geosocial nature that can affect the business model of the bank. It can affect the bank's business position. And that's where operational risk models need to be more, I think, more innovative in taking into account these risks.
Thank you. And as part of those, you mentioned sanctions, and it's since essentially the conflict in Ukraine, sanctions have become quite important as well as part of that thinking. And so there's EU sanctions regime, there's other jurisdictions, and it seems to me that it's quite challenging for banks that have such complex business models and complex dealings to really be on top of every essentially transaction that they're making and not to fall essentially subject to sanctions breaches. So what kind of do boards need to be aware of? Where are kind of the bottlenecks here?
Well, that's an excellent question. And at a basic level, banks ought to be designing risk-based models to deal with sanctions, because of course they can't know every customer perfectly, but they need to have certain frameworks in place that are risk-based. So particular transactions with certain customers in certain jurisdictions that are jurisdictions under sanctions need to be more closely scrutinized. They present a red flag, you might say, and transactions that are with jurisdictions that are not a source of political risk or sanctions, or not the object of sanctions, then there doesn't need to be as much scrutiny. And I think what the regulator is looking for regarding sanctions compliance is a risk-based framework in which the bank has data on its exposures to customers and to businesses in different jurisdictions. In some of these jurisdictions, sanctions are more relevant than others, and that's kind of the starting point. And the second point would be, even in jurisdictions where you don't really have a sanctions risk, banks need to be like, say, the EU. The EU, of course, doesn't impose sanctions. I mean, inside the European Union, the financial markets operate fairly normally in the internal market. However, there are non-EU banks that operate in the EU, and some of those banks are based in jurisdictions that are the object of sanctions, like Russia. So one of the examples of a big sanctions case in the EU was Sberbank. Sberbank is the largest bank in Russia. It's a partly state-owned bank, and Sberbank owns subsidiaries across the EU, especially in Austria and some in southeastern Europe. And when the war started with Ukraine, the EU imposed sanctions on Sberbank and Sberbank's parent company in Russia. And so, the subsidiaries that were owned by Sberbank in Europe basically became sanctioned entities as well. They were not able to get liquidity, not able to get loans from other non-sanctioned banks. And that presented a big challenge for European banks that had exposures to Sberbank's EU subsidiaries. And so Sberbank was basically taken into resolution. Even though the bank was generally operating solvently, it lost liquidity because banks stopped lending to it because it was viewed to be a sanctions risk. And so banks need to review their exposures. What banks in the EU are they owned by companies or businesses or even states that are of political risk?
Oh, very interesting. And I'm guessing there's obviously this underlying of sanctions political risk where banks and bank boards need to think about these exposures and indirect kind of exposures through transactions and ultimate owners that are not known. But I think there are also kind of hidden exposures potentially through digital assets and intermediated flows in the digital economy that might be where careful thought needs to be, and where tracing might be a bit more difficult. And maybe we'll move on to that then, to the digital space, and in particular to stable coins and crypto, because I think there's quite some interesting developments happening there. So maybe you can elaborate on what's going on.
Yes, I think the area of crypto assets is one of the new areas of business, of course, that represent opportunities for banks and other financial firms and investors. However, they present risk. And so we're seeing that right now. A lot of the crypto asset space, you might say, is not transparent. It's not well understood who the ultimate beneficiaries of crypto assets are, because there's not a lot of disclosure requirements. There's not a lot of rules on transparency. So regulators are slowly moving into this area with the new EU market and crypto assets regulation that's become effective in the EU in 2024. They're going to be more demanding standards of disclosure for the owners of crypto assets and also for the companies that issue crypto assets, crypto asset service providers. They're going to come under substantial new regulatory requirements. Banks and credit institutions have not normally owned crypto asset service providers, but as these institutions become regulated under EU law, there will be the opportunity for banks to consider moving into this area of business and to own crypto asset service providers. And that is a real opportunity. And so bank strategy ought to be thinking about how they can blend technological innovation and the area of crypto assets into their business strategy, but they need to do so in a way that also takes account of the risk that are involved, and especially with the fact that a lot of crypto assets are used to evade money laundering controls. Crypto asset transactions are also used very often in Russia to evade sanctions restrictions, and so there needs to be better understanding about how this area of the market can be supervised. Amir also mentioned stablecoin. Stablecoin represents a huge opportunity for banks, I think, right now. Stablecoin is a type of parallel currency. It's a digital asset, but it's really a digital asset that is used as a base to make payments. And so we see this very popular in the United States right now with US dollar stablecoin. And I just read a few days ago where the first Euro stable coins are being issued now by crypto asset service providers, and so these digital assets can be used as a type of parallel currency that can be used to purchase goods and services over the internet. And we're going to see increasing use of this. And this is an opportunity for banks. And I think banks can play a role here in two areas. They can play a role by, first of all, offering what are known as tokenized deposits, which are like, that's like fiat currency, like the pound sterling or euro currency, a bank deposit that's a tokenized asset that can be used to make payments on the internet. But then they can also potentially in the future, they will be able to issue stable coins, and the stable coins are not fiat currency, but it's a coin, a digital asset that's linked to a fiat currency like the dollar or to the euro or to sterling or some other currency. And this market is, so both of these markets are going to grow. And I think banks are in a better position to start out with tokenized deposits first, as some banks are doing already in the UK. But in the future, banks, I think, are going to need to compete more in the stablecoin area, because that's going to be a huge area of growth and potential profitability.
Absolutely. And I think this is where an area where banks maybe historically have been a bit reluctant initially, given essentially the security risks and maybe some of the risk around money laundering. But now, as you mentioned, with a more favorable regulatory environment in the US, but also in Europe, we see a lot more banks getting into this space and being involved in essentially with tokenized deposits, as well as some of the stable coins for settlement, right? So essentially building a blockchain infrastructure for settlement. And I think there's something going on there as well. But do you see, apart from the traditional, what seem to have been evading money laundering rules and what crypto essentially currencies have been associated with, do you see any other risks for banks, and in particular what bank boards need to think about when their bank is starting to think to build essentially a stable coin environment or a blockchain settlement environment or a tokenized deposit? Are there any other issues that also the regulators might want banks to focus on?
I think one area, that's a very good question. It relates to data protection. So as technology is improved and the use of stable coins and other crypto assets are being conducted by banks offering these services to their customers, there is a risk of data loss, of personal data loss of both businesses and individuals, and that having better IT systems for data protection is going to be a very important internal challenge for banks to update their systems, because right now their systems are based off legacy banking business and traditional credit and market risk models, but as they move into the area of tokenized deposits using digital assets as part of their business model, they're going to have an associated data protection strategy to go with that, because the loss of personal data is going to be a huge source of concern and also potential liability for banks that are not seen to have done best practices in this area, potential lawsuits or regulatory enforcement actions.
Because I guess one benefit of, say, tokenized deposits is, of course, that they are settlement is immediate, right? So it's so instantaneously, and it's to some extent you can break them down into the atomic units, so it's not essentially they're very fungible. On the other hand, I guess banks lose control over the verification because it's on a shared ledger, right? So
Yeah,
and
yes,
that's where
yeah,
the
yeah,
information,
right.
that's where I think you mentioned that potential privacy and information
Hmm.
um, security is important.
Yes, exactly. Well, the blockchain, a private blockchain, is where the settlement of these transactions take place, and this is an area that banks are not so adept with now in monitoring and managing the data flow on the blockchain, on the ledger, and this is where banks have to get up to speed, invest in understanding this technology better so that they can use it in their business, but also have safeguards built in for data protection, as well as making sure that payments get settled. Settlement, and one of the advantages of using blockchain is that you get almost instantaneous settlement. Whereas if you go through traditional interbank payment systems, it can take, it's pretty quick in Europe, but it still takes a certain amount. Yeah, it's a few hours in the day, and even in the U.S., it still takes several days to settle payments between banks in the United States. So in most countries in the world, bank payment systems are very inefficient and they've got infrastructure that really needs to be modernized. And the blockchain really represents a future model for how transactions can be conducted almost instantaneously,
Mhm.
and that this enhances efficiency in the banking system.
Yeah. And from the regulatory point of view, are there any kind of systemic risk issues with stable coins or kind of blockchain transactions? Are the
The,
regulators concerned about that?
there are some, right. The Bank of England, for instance, has published a paper last December on what they call systemic stablecoin, and they're basically arguing that there needs to be sort of liquidity requirements and limits on the issuance of stablecoin by UK banks, and limits on customers. So that there's some proposed limits of roughly 20,000 pounds sterling per customer per bank, because there's concern that people will be over concentrated in their holdings of stablecoins, and if there's a run or a liquidity problem with stablecoins, it will create a systemic crisis. The Bank of England thinks there's a concern there. I don't want to question that or argue with it. I think what we've seen in actual practice regarding stablecoin and crypto assets are more conduct issues that relate to investor protection over the last 2 or 3 years. We had the failure in the United States of Terra, the big stablecoin issuer, in 2022, and then since then some smaller players have failed. A couple, FTX, the platform failed, and these didn't really create systemic risk. They created more kind of customer investor risk, that people lost their life savings. And how do you recover from a stablecoin issuer that basically becomes insolvent because it didn't have good controls, it wasn't regulated, there was no real disclosure requirements, and so therefore um, I think today we should be more concerned with investor protection conduct issues in the area of crypto assets. But of course, the Bank of England and other macro prudential regulators ought to be kind of monitoring how this develops regarding systemic risk.
Hmm. Particularly because I guess stable coins, you would assume as a customer that stable coins are stable coins because they're
Yeah,
pegged one to one. And that obviously, in the case of Terra, we've seen that that's not the case, or that wasn't the
right.
case.
Yeah.
And that's given the lack of control. So I think this is a space, there's lots to be discussed
Mm-hmm.
still, and very interesting issues will probably come up as these stable coins and other digital assets become more common in the traditional banking system. And there's of course central banks and CBDCs as well. So central bank issues currencies, but maybe that's for another day.
Mm-hmm.
But I think related to this, and you kind of touched on this, as you said, okay, there's data privacy issues, is cyber risk for
Yeah.
banks. And with that, I would kind of AI comes in as well. So how are banks, what do you think is kind of important? What are the kind of biggest issues here in terms of cyber risk for banks in particular, also again with the view of what regulators are expecting of banks to do and where responsibility lies now.
Yeah. Well, regulators will require a designated member of the board of directors to be the responsible individual for the regulator to communicate with regarding operational risk. And so that's the case in the UK and in the EU. And if it's not someone individually designated, it's going to be the bank board collectively. They're going to be responsible for addressing operational risk concerns that the regulator has. And with respect to cyber attacks and cyber risk, I think there's kind of it's this problem that's been with us for some years now about hacking into banking systems, obtaining personal data, or also hacking in to accounts and stealing money, and different types of fraud, whether it's kind of pull fraud, pull fraud where you get a hold of customer details and contact them and persuade them to transfer money to you because you're using someone, you pretending to be the bank. So the bank has got to have good safeguards in place to let customers know that that they may be contacted by fraudsters and not to respond. And there are operational risk guidelines that regulators and banks have worked out, at least in Europe, regarding how to manage this. But the fraudsters are very they're creative. They come up with different ways to penetrate banking systems and to reach out and to contact customers. And so I think that a lot of this is based on the collection of data, making sure that as the technologies change, the types of fraud and the type of cyber attack will change. And so the bank needs to be always collecting data and learning about where their system is vulnerable, and then taking that into account and having this as part of the dialogue that they should be having with the supervisor, the bank supervisor.
And I can imagine that with the development of AI tools and these large language models, these types of frauds are actually becoming easier to perpetrate by the people, as essentially the AI models enable, also enhance kind of these fraudulent activities. So that's something I think banks need to be aware of as well. And that actually points me to the question that comes from the audience, which I will pick up here. Stefan Traber has a question where he says he's seeing increasing reliance on AI in the banking sector. So, and that's related to, I think, customer servicing customers and maybe even AI models in default prediction and so on. But how prepared do you see current risk frameworks and stress testing for new risks arising from an increase in reliance on AI? So do you think banks have they updated their risk frameworks and stress testing?
Yeah, I think they have begun to do so, but this is an area that has not, banks could benefit from more expertise on how to manage the risk from AI. And right now, although bank risk systems do address the problems that AI poses, they're not experienced in doing so. And we're seeing increasingly more customer complaints regarding AI. And even when banks use AI to advise customers on what products they might want to sell them. I mean, there's like robo advisors or whatever it might be. I mean, that was kind of an old model, but today we see AI used in a wide variety of contexts. And I think the risk safeguards that banks have adopted for AI are inadequate now, but it's part of learning in the market. As the technology gets better, the banks need to be vigilant and updating their systems to address these risks, and kind of monitoring how the use of AI affects their customers. I'm not really sure that many banks are so in touch with their customers about how they're experiencing AI. And they could probably learn a lot from their customers through customer surveys or other types of interaction.
Yeah, and I think I absolutely agree. I think there's a lot to say around the increasing use of AI in a variety of banking services as we see it's being rolled out, right? And I think there's yet I think we haven't yet seen major blow-ups in that sense. That, but I think something to be probably prepared about. But another angle to this is, I think, also as AI becomes more autonomous in its use in and how banks use AI in the services, so makes decisions essentially autonomously, maybe for credit provision or other whether a mortgage gets approved or not. I think there's something to say about that decision needs to be explainable somehow, right? So it can't be a black box.
Yeah.
And obviously, there's a lot of talk around biases that are kind of embedded in these models that potentially will bias certain sectors of the population against credit provisions. So access to finance becomes an issue, and so are regulators concerned about?
Well, there's an important implication of AI about its impact on financial inclusion. As you say, these credit risk models that are designed in an AI system will decide who gets a loan or not, and this may the criteria incorporated into the AI model may discriminate against certain groups. It may discriminate against those who are, for instance, self-employed and not and don't have regular employment with a third-party business, for example. So similarly, I mean, banks that don't use AI to make credit risk decisions have these issues as well. But in AI context, you really take out the human element completely, and you're basically feeding data into a model that will make decisions on credit allocation that will have social implications. And it may favor males over females, given whatever demographic data are fed into the AI model. And those are things that banks need to take into account, because if they knowingly do this, they potentially open themselves up to a type of liability for knowingly using AI models that allocate credit based on so-called discriminatory factors that might discriminate against certain racial groups or gender discrimination, even age discrimination, retirees versus people in working age levels. So I think these are all challenges that banks have really not really thought through yet in the use of AI. I think AI is really helpful. They need to use it, but there needs to be a human oversight of it, because you need to have kind of the human application of the policy objectives that we have as a society, for making sure that we don't have discrimination against certain groups based on non-economic factors. And AI will just could lead to invidious discrimination that we don't anticipate now.
And this just becomes even more important, I think, as we're seeing developments of these agentic systems that essentially where potentially customers or others will let their agents do transactions and autonomously make any transaction. And we have seen cases where private information has been essentially made public, credit card data has become public, all sorts of, or even there's deleted, like data has been deleted autonomously by these agents erroneously. So I think this becomes quite an interesting area to focus on. And indeed, it's to some extent, banks have been prepared to some extent, but as you say, it's not quite there yet, and they're learning, and which is interesting as they're learning on the go. I think because these systems are developing so fast, I think we'll see quite a few interesting cases in the future for sure. And that leads me essentially then to think about, okay, we have now geopolitical, we discussed geopolitical risk, we discussed stablecoins, AI, and associated with those fraud risks and other potential risks that boards need to be aware of. Now, in terms of accountability of the board, and I think over the past few years, we have seen an increased accountability regime across the various jurisdictions in terms of what is the liability for bank boards, right, and decisions, and maybe even senior management in banks, which we haven't seen before, right, in terms of personal liability. And with that, I think we've also seen in parallel conduct issues, right, around culture. So how do you, what are the kind of the recent developments there that you have seen, and what you think is important for bank boards to know?
Well, bank boards need, I think we've had the examples in the UK, especially, but also in Switzerland. There was the Credit Suisse collapse and the crisis that got set off in Switzerland regarding UBS taking over Credit Suisse. And if we look at the source of the problems at Credit Suisse, what the regulatory bodies and what the professional advisors have concluded is that Credit Suisse's board failed to do due diligence to understand the nature of the business and the risk that Credit Suisse was exposed to. So in areas involving, say, financial crime, or areas involving certain types of conflicts of interest that should have been made known to the board was passive. They were not proactive. And I think the lessons with Credit Suisse, or not just, it's not just Credit Suisse, we see this in other areas where we had the situation in the UK regarding Barclays. The board of directors at Barclays sort of closed a blind eye to the former CEO, Jeff Staley, and his culture issues and problems, his relationship with Epstein. And we see this in other contexts in the UK in investment service firms, where the CEO is a very strong leader of the firm, but the board is timid, will not challenge them. And I think what the lessons that we're seeing across, whether in Switzerland or the UK and even in the US, is that bank boards need to be more challenging. They need to be more adversarial in testing the senior management, the CEO and the other members of the senior team, and not so deferential, not so passive. And because if they don't challenge them on certain issues that have been flagged, then these problems don't go away. They fester, they build up, and then you have a crisis. You have like a culture crisis, like you had at Barclays, or you have a financial crisis, a complete implosion of Credit Suisse, or you have other breakdowns where boards have got potential liability because they ignored failings that led to customers and shareholders losing money.
Mm-hmm. So what you're saying is, I think, that boards have to challenge management, have to challenge more management, have to be more confident in the all aspects of banking to be able to make informed, essentially challenge, but on an informed basis, challenge management in their decisions and in the conduct. And of course, regulators are really focusing on that aspect in particular as well. So I'm conscious of time and I want to give opportunity for participants on this call to ask questions. I know there's questions in the Q&A and there's questions in the chat, so I'm trying to kind of manage both here. I think there's one question here by Moya Alboni. Could you please touch on the issue of overcompliance and de-risking by banks, which preventing jurisdictions from integrating into the international financial system? This is especially crippling for smaller economies like Syria, where market incentives remain meager. What can banks in such situations do? So I think kind of the heart of this question is the notion of there is in some jurisdictions, and I'm to some extent we've seen this in the US, where there's been now a lifting of some of the harsher regulatory requirements, and there's even a discussion of loosening the capital requirements. So there's been a focus on compliance and de-risking by banks, and that obviously cripples what banks can do. And whether you think that's also on the international level, in this case in Syria, whether that disincentivizes banks from operating efficiently, or whether that's actually inefficient. That's what regulation is supposed to be. So is there an over-reliance on regulation? Has the pendulum swung too much in generally? And then we can talk about emerging markets where this is a bigger issue, of course.
Yeah. Well, I think that it's the data is pretty clear, and the regulators have acknowledged, not just in the U.S. but in the U.K. and in Europe, that the bank capital and liquidity requirements were probably a bit too strict in some areas, and that the leverage limits were probably hindering the ability of banks in certain cases to get more liquidity in situations where you have volatile markets. And so regulators have been adjusting to that. And so we've been the UK, for instance, has lowered some of the capital buffer requirements for the systemic banks in the UK. The ECB has been looking into sort of more favorable risk weightings for banks on which affects the calculation of the capital they have to hold. And in the US, we're seeing basically the not a disregard for capital requirements, but just really an adjustment of the capital requirements and the liquidity requirements. So the new head of supervision at the Federal Reserve is Michelle Bowman, and she's a community banker from Kansas, and she kind of sees this from a small bank point of view. And her argument is basically that some of the Basel framework is too prescriptive. It's a bit too much for many small and medium-sized banks to comply with. And I think that might get to the concern of many jurisdictions where you don't really have two huge banks like JP Morgan. You've got kind of medium, small banks in developing countries. That the Basel framework is probably in many cases too prescriptive. And so we see the need to try to adjust its application now, which I think is a good thing. And so I think what we're going to have to find out is really how can you adjust it for small and medium-sized banks, and then also how can we adjust it for big banks so that they have the same incentive to have liquidity in the market without hindering their ability to provide liquidity when markets are volatile. So yeah.
Yeah, no, interesting. And that's obviously on mostly on the credit risk side where and liquidity, where essentially the stringency has maybe inhibited credit provision and liquidity provision. And there's another side is on the conduct side that we touched on, and that Moayad is also hinting at, is which becomes more important for certain jurisdictions and emerging markets that potentially previously have been sanctioned, any transactions, so say Syria, where sanctions have been lifted, but banks are very conservative and still are rejecting transactions, maybe because they think the regulators are still kind of too focused on these potential sanction breaches. So is there something to say around that there's too much heightened sensitivity around not falling foul of sanctions? So there's an over compliance or too kind of risk averse.
I think that's always the risk when you get very strict regulations and compliance becomes very prescriptive, the rules that the regulator requires. I think it's important that in most jurisdictions, so regulation should be risk-based. It can never be perfect. You can't, and so therefore banks, through their own internal controls, their own collection of data, they can identify where they think the risks are more likely to occur. And that's really where their internal focus should be. And the regulatory requirements basically are essentially risk-based. And so there's kind of a deference to the bank to collect data and based on that data for the bank to identify the risk and then to and put that data into a model and to get it approved by the regulator. And so I think the framework is a sound framework, but yet it does have the tendency to lead to over prescriptive regulation. But I should also say that in Europe, the legal requirement and also in the UK is that regulation has to be proportionate. Proportionality is a legal principle that the regulator can be challenged on. So the regulator may require a lot of very detailed, specific rules that make it very costly for the bank. But if the bank can show, look, the risk we're exposed to are not really in this area of compliance, and we think the regulation is not proportionate. And
Mm,
so that you can have that discussion with the regulator about proportionality. Of course, banks don't want to go to court and sue the regulator because you want to have a good relationship with your regulator. But I think the proportionality issue is often mentioned, at least in EU discussions, as being a really important principle that shapes the development of regulation. And I think that if that can be done sensibly, then banks shouldn't have to worry about the kind of over prescriptive rules that have been applied.
yeah. Yeah, and I think on top of that, given that most banks operate internationally, I think
Hmm.
regulatory fragmentation is a concern, and there's
Yeah.
a question around how harmonized you think regulators are in multi jurisdictions on all these issues that we discussed. So do you think we are moving to a more harmonized or more fragmented world?
I think we're unfortunately moving to a more fragmented world because it's becoming because regulators basically have a lot of discretion about the types of models and the type of practices they apply to the banks. They start out with the Basel framework as kind of a baseline, but they have a lot of discretion to be stricter and to have different types of additional requirements on top of the minimum Basel framework. And we see that. I mean, even in the U.S., there's even stricter rules than what Basel requires regarding capital in the use of risk weights for banks, for example, than what they have in the EU. And so we're always going to have this unlevel playing field. It's going to pose a business challenge for banks. But yet, I think in some ways, having regulatory diversity is kind of a good thing because if all the regulators are playing by the same playbook and doing the same thing, there's the risk that if they get it wrong, we're going to have a giant global catastrophe, right?
I think,
Yeah, and so I think a little bit of diversity in risk management for banks in different jurisdictions is a good thing. Fragmentation itself per se is not so great, but yet banks have different sets of data, different sets of information from different economies, different financial systems, and that should inform their risk management practices. And so regulation ought to sort of recognize that diversity. And so I to that extent, I think fragmentation is not so bad, but yet I think fragmentation is not good when the ability of banks to transfer liquidity across borders is hindered. And so when you run into capital restrictions and capital flows are impeded, or asset management companies are not able easily to invest in foreign jurisdictions because of just completely regulatory obstacles, then that is not necessarily a good thing. That needs to be more harmonized. So I think there is kind of a balance that you need to strike.
yeah. Yeah, and I think one last kind of issue that I want to raise or question, and then I'll hand back to Sarah for the closing, is related to that. Outside, so there's regulatory fragmentation within the banking system, as you mentioned, and some of it is to some extent good, some of it maybe um, creates problems for banks. But there's also differential regulation of the banking sector as a whole versus the
Mm,
shadow banking sector, and we are now
yeah.
seeing private credit institutions, right, that are
Hmm.
getting
Hmm.
into trouble. Fintech is also outside that sphere. So, do you see this as an issue? And is what we're seeing in private credit? Are this the first signs of there might be systemic risks outside the
Hmm.
banking sector that might
Hmm.
come back to haunt the banking sector because they've been providing loans to these institutions?
Yeah, that's a very good point. I mean, the strictness of Basel III and bank capital and liquidity regulation has led to a lot of medium-sized company lending being moved away from regulated banks to private credit funds. So private credit groups set up funds, and these funds will lend money to companies, medium-sized companies, small companies. And this market is probably most developed in the US, but it's also a pretty big market now in the UK and in parts of Europe. It's growing, but in the US, it's probably developed so much where it might be understood to be systemic because the amounts of credit flows have become substantial. And so the issue is that does private credit and the potential that you could have defaults on these loans, which seem to be going up in the U.S. right now. Does this create a systemic risk? And And I don't really know the answer to that because I've read two, in the Financial Times just a couple of days ago, Roger Ferguson, who used to be the vice chairman for the U.S. Federal Reserve, he's now head of the Private Credit Risk Association in the U.S. And Mr. Ferguson argues that, well, no, there are defaults, they're going up, but the private credit industry, he argues, is not systemic because you've got these gates that can be imposed on creditor withdrawals. So they can't get. It's not like you can't have a bank run in the credit fund context. So you don't have the same types of deposit risk that you have. Because the system is structured differently. And so he thinks the problem is more about containing losses that pension funds might have and other big institutional investors might have, that all of us indirectly might feel the loss in our in returns, and that it's not going to be so systemic. But there are others like the IMF, the BIS, and the Bank of England have done studies showing that the rising defaults in private credit markets can lead to a type of knock-on effect, a loss of liquidity that can even impact the banking sector, because the banks are actually moving a lot of this money off their balance sheet and selling it to private credit funds. The loans that they make, they're basically securitizing it or moving it off their balance sheet so that private credit funds can take over the same loans and provide the credit, and that the banks are expecting this cash flow to come back on their balance sheet. And so if this stops suddenly, this could be a liquidity problem for the regulated banking sector. So I think that there's some risks that we don't really fully understand right now in the private credit space. But having said that, there are risks. Recently, there have been some reports by BNP Paribas and by Deutsche Bank, some comments made by senior management there, that in Europe, at least, credit funds in Europe are underutilized, and that there is a huge opportunity for private wealth clients of European banks to invest their money in private credit funds. And the areas they focus on are energy companies, technology companies, and the environmental sustainability transition companies. That's the three market segments that have been promoted by some European banks to try to attract their wealth management clients to invest in credit funds. So I think, and the thinking is that this market is not as developed as the US market. And also the argument is that the EU market is better regulated under the UCITS regime, undertaking for collective investment transferable securities. The whole asset management industry and the regulation of funds is stronger in the EU than it is in the UK than it is in the US. And so you have better investor protections is the main point. So it's not really a financial stability problem. It's about investor protection, I think. And I think Europe has got a potential here. It's a potential strategy for banks to make money by directing clients into this area. But we'll see how that plays out.
Thank you. Yeah, we certainly will see how that plays out. So we see, I mean, we touched on we covered a lot of ground, from essentially conflicts and the impact of political conflicts and geopolitical risk on banks, how regulators think about it, digital assets, cybersecurity, and stable coins, all the way to conduct risk and culture, and of course some of the regulatory landscape and shadow banking differences. And I think there's lots to say, and obviously lots for bank boards and leaderships at banks to really think about, and how to essentially strengthen risk management systems and their capabilities. And if the audience liked this discussion, we will delve much more into detail in our bank governance program in June or July. It is, I'll remember. Sarah will tell you, and I hope you will join us then. And Kern, I have to thank you for really delving into much of the details. I essentially just posed questions to you, so thank you very much for this insightful discussion. And I'll hand back to Sarah.
Great.
Thank you.
Thank you.
so much, Amir and Kern. That was just a wonderful conversation to listen to. And I know everyone who's joined us today has really enjoyed it. That was a great number of people. And it was wonderful to see in our guests and the audience, we have some alumni joining us, some people who have applications in, some people who have already confirmed their places. So a wonderful mix. So a warm hello to all of you. And to those who might be thinking about joining, I just want to say that last year's bank governance program attracted 40 participants. We had 21 different nationalities from 10 different industries. And for the first time ever, we had equal gender in the room. So that was wonderful. And we expect it to be the same again this upcoming iteration. So that will be running from June 22nd. So I'll just share my screen here. If anyone has any interest in these programs, please do scan the code here. It will take you straight to the information. You're also welcome to reach out to my colleague Clara, who's been in the chat and posting some information for you. Click on that link, email us, book an appointment, because we would love to see you in person for 5 days in Oxford, and we'll talk you and walk you through the process. But just a warm welcome and goodbye from Oxford. We hope to see you in person soon. Thank you again, Amir and Kern and everyone. Take good care now. Bye-bye.
Thank you, everyone. Thanks for joining and great
Thank you.
questions. Thank you.
Great. Thank you. Bye-bye.
Thank you. Thank you, Karen.